You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to this Investing Matters podcast. My name is Peter Higgins and today I have the privilege of speaking with Neil Shah. Neil Shah is the Head of Business Development for the tech sector of the London Stock Exchange and is previously an investment banker for over 15 years, so he's got a vast array of experience. Now, Neil, I want to start really because you've modestly state on your LinkedIn profile that your job is helping tech and tech-enabled companies to go public on the stock exchange. However, we know you do far more than that. So during this interview, we're going to try and explore what your role is and what aspects of investing really matters to you. So firstly, I want to start with education. Yeah, you went to LSEG, London School of Economics. What was your first sort of inklings that you interested in maths or anything to do with that sort of, specialism as a young man?
Peter, firstly, thanks very much for having me. I'm a big fan of your show. I've been listening to it for years and really appreciate everything you're doing to help educate retail investors. And I guess I was one of those guys on that journey trying to figure out what to do. After school, I took a gap year. I had enough of studying and then came back to the London School of Economics, where I really enjoyed economics as a subject. I saw myself having a career in the city. I wasn't quite sure what that was going to entail. Would it be in trading? Would it be in sales, investment banking, fund management? And the benefit of being at the LSE is that you were exposed to so many alumni who've gone on to some of these institutions, also gone on to work in government, and it opens up pathways for one to sort of think about. So it's a great place to start and learn much more about the real world rather than just the academic world.
Brilliant. I mean, you were fortunate enough to get a placement at Lazard. There's many big places than that. Summer placement going in as a young student. That must have been absolutely phenomenal going like that.
It was wonderful. Look, I was the first of my family to go to university and get a placement at Lazard, but it was incredible. Just yesterday, I was speaking to a chap, Giles Rocher, who actually hired me for that role. He's now at Cowen, and this is just how small the city is, that people are still floating around. And I've had the benefit of having so many people help me along my career, be it at school, getting me into secondary school, getting me to university, and then help me get into the city, for which I'm really grateful.
Brilliant. Now, I want to move from your placement, your little time at Lazard. Quick synopsis, really, if I may, from your role there at Lazard all the way to being a director at Stifel, and just share some of the nuances of that particular journey.
Sure.
An investment banker of all,
Sure. So Lazard was, I guess, a test by fire of what investment banking would be like. It was an 8-week placement over the summer where you're given a week of training, showed how to use Excel, showed how to produce pitch books, and then unleashed into the wild, where you're taken along to meetings, sat in lunches, exposed to clients in some cases. And it's a great way to figure out if this is the career for you. I decided to pursue a career in M&A. So finished that placement at Lazard, went back to uni, got my degree, and then got a job at Dresdner Kleinwort in their tech M&A team. So I was doing that for the first 5 years of my career. I don't think I saw a weekend in that first year. I think the highlight was going to Washington, D.C. for a day trip to sell a business for Vista Equity Partners. And it was just a really interesting time to learn, to start my career. I really wanted to get on the housing ladder, which is partly why I chose investment banking, where it was perceived to be slightly more lucrative than starting out as an accountant. And in hindsight, I probably should have gone down the accounting route and picked up a professional qualification, but that's a story for another day. Look, it got me to where I am, and after about 5 years at Dresdner, I had the opportunity to go and work for a US boutique, Thomas Weisel Partners, who were doing deals in Silicon Valley, taking companies public in the States. It was just a very different platform to what I was used to. And Stifel was a fantastic place to grow. Stifel came in and bought TWP. So I think we start off with 20 people. We're about 5 people at the low point and about 450 people when I left. But it gave me the opportunity to work with the likes of George O'Connor, who you know, Fred Walsh, and a lot of US sector bankers who were just experts in their field, be it cybersecurity, semiconductors, internet. It gave me a really worldly view of what there is to be excited about in technology. Unfortunately for me, Stifel decided that there was actually a lot to do in the UK. Yes, we could start off by preaching to the likes of Just Eat and Delivery Hero and trying to convince them to go public in the States. But actually, some of these companies are better off just listing in their home markets. And I'm really thankful that people like Mike Rowe at Just Eat didn't listen to my advice, decided to go public in the UK, because I think they did phenomenally well leading up to their merger with Takeaway.com.
I want to go back, if I may, because I'm conscious of the time we've got on this interview, but I've got to ask you about some of the experiences around that time of 2005 to 2008-9, when the tech sort of euphoria regarding some valuations of stocks was going through the roof, and the number of IPOs were absolutely phenomenal during that sort of era as well.
Sure. Well, I guess that was a bit of a low point, Peter, because we had the tech boom in 2000 with everyone getting carried away with life. I was listening to a podcast yesterday with Benchmark talking about Webvan and how exciting that was at the time, how it was a fantastic investment for the VCs, less so for those public company investors. Sort of fast forward to 2005. I think we were just starting to get going again. M&A was picking up. I was very much focused on the private side of the markets at the time, so less exposure to public markets. But I remember looking at a lot of public companies in 2007 with a number of UK PE firms like Duke Street Capital, where debt was phenomenally cheap. This is, of course, before the credit crunch. And I think I worked on 7 private equity buy sides, none of which succeeded because it was just really hard to actually get these deals done in the end. Those debt deals, which are equivalent of mortgages, quickly expired, I guess, a bit like what we're seeing right now. And that market changed, and I ended up working on a few take privates. One was Civica coming off with Free Eye, and what I've seen is these are really resilient companies. If you look at Civica back then, Civica now, it's transformed. You could say the same for a business like Keywell that went public recently in the US. These companies don't stop growing, and I think sources of funding are interchangeable. Sometimes it's better to be private than it is public, and other times better to be public than private. And I'm really glad to be at the LSE, where my CEO, Julie Hoggett's vision is to one day be agnostic between public and private markets and really just give companies what they need, which is access to capital.
Brilliant, thank you. Now we're going to go on to your role now. So share with us a brief overview of that role you have, the specialist role in the tech sector for the London Stock Exchange, and how it plays a part in the initial public offering and the listings of companies. Just expand on it as much as you like here, because I think it's very important what's going on. And obviously, I'm a bit of a tech guy as well, so I love what you do.
Thanks, Peter. So my job is essentially to go out and meet founders and management teams and directors and help them understand what their options are. Very often, when you're a CEO, the advice you're receiving is often biased by the people with whom you're dealing. So if you've just been speaking to an M&A advisor or a private placement agent as you've been growing your business privately, the chances are that they may have had little exposure to what the art of the possible is on the AIM market. And our job here at the LSE is just to open people's eyes and show them what's possible. Everyone likes to talk about Amazon, and if you'd participate in their IPO in 1997, if you invested $10,000, that would probably be worth about $13 million today, sort of 33% annualized return. There's companies in London that have achieved a similar return to that, albeit over a sort of shorter time frame. And it's just highlighting what the art of that possible is for those founders, for those management teams, so they can create wealth not only for themselves, but for their employees, go on to acquire businesses. And I think there's a real lack of awareness in the UK. It's not really in our DNA to think about an IPO and to be ambitious. I've met many CEOs who'd be happy to make 10 or 20 million, but what we're trying to show them is a pathway to build bigger businesses and create more decacorns and centacorns, and the sort of companies that we're very familiar with that are on NASDAQ and NYSE. There's no reason why we shouldn't be able to have them here.
Brilliant. I love that. I'm going to quote something here because I thought it was quite a fascinating sort of viewpoint that was given by Peter Holton Moolman, the founder and chief executive of Trustpilot, when speaking about why he chose London as a destination for his company. And a factor he spoke about positively was that he was seeking an IPO as a service. Now, as a director of and the tech specialist segment of the London Stock Exchange, you must be immensely proud when somebody says that, especially from an overseas company that's now chosen to list in the UK.
Yeah, look, we're delighted to have Peter and Trustpilot in London, where this is a global business. They can access global investors. They can grow their presence and have a currency that they can use, be it to raise further capital down the line or execute mergers and acquisitions. And this is a company with I think just over $100 million of ARR, which would have been a small company in the States. And as I saw firsthand at Stifel, there's a real risk of getting orphaned if you're too small in the States. Whereas the benefit of London is that we've got a market that works for companies of all sizes. We had North Coders join last year with a £30 million market cap, and we also had Wise with about £8 billion of market cap. And both of those companies have demonstrated how you can be successful in London. But to Peter's point about providing the service, that's exactly what we want to do. An IPO is just the start of the journey. We want to make sure that companies can use their equity efficiently, and if something's not working, we'd love them to come and speak to us and explore how we can fix things. Sometimes that involves changing the advisors around the table, where companies may have outgrown their current advisors. It might be looking at liquidity or how to get into an index, and through those means pick up additional investors.
Brilliant. Now, you've touched on it a little bit, but I want to go back, if I may, a little bit more about the actual IPO process and also about the actual governance aspect of it, because obviously there's some companies that might approach the London Stock Exchange and you go, actually, I don't think we would like to proceed with that on our behalf. You might have to look at another exchange.
Sure. So let's take the governance question to begin with, Peter. Look, we're really just a venue for convening those of capital and those of ideas and matching the two. We're very fortunate to have a really robust regulatory framework in the UK. So if you're going public on the main market, it's the FCA that are screening the prospectuses that advisors are submitting on behalf of companies to make sure that that the company is fit and appropriate for the public markets. When it comes to AIM, we've got a separate division of London Stock Exchange PLC, AIM regulation, who many investors and companies will be familiar with, who are robust in their approach, and they try to ensure that companies that are coming to market are again fit and proper and ready for life on public markets. AIM is particularly interesting because you've also got the Nomad nominated advisors performing a regulatory function as well. When I was at Stifel, I wasn't a qualified executive, but I sat alongside several of them, including Fred Walsh and Alex Price, and their role was to ensure that clients were following the rules, and if they needed to put out an announcement, that announcement was being put out in time.
Brilliant. Now, I'm going to touch on AIM in a little while in a different question, but I wanted to ask you this question. You've supported many companies through the IPO process, Neil. How often have you seen a real positive change internally with the company once they've had that IPO and gone through the process, in the sense of culturally they're a little bit more like aware of who they are and what they're about, because they're getting that sort of resonance from international clients and customers now?
Peter, I can't think of a single instance where that's not happened. Part of the journey of listing is to professionalize the operation, and very often we meet founders that have been running a nice business privately where you don't need to produce accounts regularly. They're just for their internal purposes. And part of the rigor of going through that IPO process is having a set of accounts and KPIs that they can share externally, having a presentation that they can deliver succinctly with new investors who might be unfamiliar with that story. And I think that's just really good practice, being able to nail that elevator pitch, but also being able to go into detail when a fund manager like Anna McDonald at a Marty or a Guy Feld really wants to hone in on what's driving a particular business or division.
Brilliant, thank you. Now, going back to AIM, there's a distinct difference between listing on the FTSE and AIM, including the likes of inheritance tax for the founders and so on and so forth. Do you want to share any of the other nuances that are quite important and specialist segments that you've got?
Sure. So the ones that are really relevant for companies are AIM or the main market, and it's the premium segment, the main market, from which you get access to the FTSE indices, be it the All Share, 250 or the 100. The real difference, I think, is that AIM is now 27 years old. It was designed for companies that were perhaps a little earlier in their life cycle that needed a bit more flexibility and support from the nomad regime. And I think it's a hugely underrated product for companies and founders. We've got 216 tech and tech-enabled businesses in London today. 153 of those are on AIM, so about 70%, really for good reason, because a lot of these companies are serial issuers. They'll come back and raise additional capital each year to do M&A, and they can do that without a prospectus, using a circular pretty efficiently, as Cape Technologies did very recently. Deals are done in weeks rather than months. So that's often even faster than venture capital can operate. And this provides particularly fast-growing tech and healthcare companies with that flexibility that they need to grow quickly. And we've seen this with Cape, as I mentioned, but Learning Technologies Group, CentralNick, Keyword Studios is on AIM. They've done over 50 acquisitions, partly down to the flexibility that this market offers. And EIS and VC funds are often the lifeblood of these businesses when they start out. I met David Braben at Frontier Developments for an interview a couple of weeks ago for our Be Inspired podcast, and they started off as a £4 million IPO on AIM. I'm sure backed by VCT money at the time.
Yeah, I saw your tweet about that, and exponential growth they've had since listing has been absolutely phenomenal for FDEV. So yeah, congratulations to them and to yourselves for helping them achieve that. Now, and that goes to my next question, really, that London's often described as the most international exchange in the world. Please, can you give some examples of why this is the case? You've covered some of this already, Neil, so
sure.
Please continue.
I think it's really historic reasons, Peter, that Britain has had quite a global role for a long period of time, and that's not dissipated. Today, we've got about 2,000 companies on our exchange. 700 of those are either headquartered overseas or have the majority of operations overseas. And as a result, the investors in London are very diverse. If you look at NYSE, NASDAQ, and other exchanges, a lot of the investors tend to be domestic investors. But in London, the weight of US capital probably outweighs UK domestic capital, which I don't think is very well known. You just take a business like Zoo Digital, which when I was an advisor to Stuart and team there, I think they had about £50 million of market cap and Frank Jennings, who runs the Oppenheimer Fund in the States, now part of Invesco, owned a 20% line in this company, which, despite its market cap, was pretty unheard of. But it just goes to show that companies of all sizes in London are accessible by these investors who are just looking for interesting companies that they can access often at an earlier point in their life cycle than they may otherwise get to in the States.
Indeed. I mean, 2021, London Stock Exchange experienced an absolute banner year of IPOs. I think I read somewhere that you said had over 100 IPOs. Why was it so significant that 2021 was such an absolute boom for everyone looking to, well, lots of companies looking to list, and quality companies at that as well?
Sure, Peter. I think there's obviously an element of a COVID bump in that. Every exchange around the world probably had its moment in the sun, but we're very fortunate to have 8 tech and tech-enabled companies list in 2020, 37 of the 126 in 2021 coming to market. And to your point, really strong businesses across the sector. If you believe that equities follow the random walk, you probably say that half will go up, half will go down, and of course there's always going to be an element of that. But if I look at aftermarket performance for London, it's actually been stronger than most exchanges worldwide, and I think that comes down to the way IPOs are done in the UK and Europe, that you get to meet fund managers 3 or 4 times before that the book's closed, and I think that provides companies with a lot of price discovery along the way, that if you're trying to price a deal too high, you'll get that feedback pretty early on and adjust down. And similarly, if it's a hot deal, you can increase the size of the book, potentially increase the price valuation accordingly, and that ought to lead to better pricing and less surprises on day one. I think it's very hard to get rich off an IPO on day one, and I would love for investors to think a bit more long term about these companies and look where they might be in 5 or 10 years' time rather than the next 6 months.
Indeed. I mean, you mentioned earlier we've had companies that have listed in the UK that have outperformed the likes of Amazon, that have gone up, and compounded over the years of 33%. So if you held on to just one of those that have listed in the UK, you could do very well indeed. Yeah,
I met Louis Hall at Cerillion the other day. He was a founder that listed his business in 2016. This was a spin out from Logica in '99. And he'd taken on some venture capital money from Malta Ventures and others. They listed in 2016. Louis still held on to a sort of 30% stake in that business, and has done pretty well. I think the shares are up about 10x. So it just goes to show what the art of the possible is. And I should also say, Peter, that everything I say shouldn't be taken as investment advice.
Absolutely spot on. Now, your role, to reiterate, is to enable entrepreneurs and boards, help them to build bigger and better businesses, more sustainable businesses as well. Neil, we talked about evaluations. Please, can you share with our listeners, global listeners, the rule of 40 and why this is important regarding valuations, please? Because it's not one that our normal investors hear of.
Sure. So the first time I mentioned the rule of 40, a lot of people looked at me strangely and asked me if I was smoking something. But it's a shortcut, really, to understanding valuation. So the way I look at rule of 40, and it's great to see more city analysts looking at this as well, is to take growth and to look at EBIT margin, and you could equally replace the EBIT margin with free cash flow or another measure of profitability or cash flow generation. But what we're trying to do, Peter, is say that valuation should not just be predicated on growth alone. What's the cost of that growth? It's how much you're burning. And equally, if you're a highly profitable business, that's going to impact valuation as well. So if you just take the growth rate as a percentage and add on the margin in percentage terms, if you're growing at 20%, you've got a 20% margin, you're on that line, that the rule of 40, that would be the equivalent to not growing at all and having a 40% margin, akin to some very mature software businesses. Or the other way around, you might be a loss-making high growth business, growing 80 or 120%, in which case you can justify having a bit of burn. And all of those ought to be equivalent, is the argument. And when we start to plot businesses on this basis, you look at an EV revenue multiple to the rule of 40, regardless of which exchange you run these analysis on, or if you're running global comparisons like we do at the exchange, you often find that those companies that have stronger fundamentals, the further they are on that rule of 40, on the x-axis, the higher the valuation is on the y, and so you often see this sort of trend line, and it's probably more of a curve than it's a trend line. Companies that are super profitable and growing really quickly, will get outsized multiples compared to often significantly larger businesses in other markets that just don't have those fundamentals.
Brilliant. I love that explanation. Thank you ever so much for that. Now, Neil, one of my bugbears regarding tech companies, especially UK ones, and I know that the plan and the strategy and the way that it's set up on FTSE and AIM is for companies to grow. They naturally grow and organically grow. However, our companies tend to get to a certain size before they're bought, taken over, subsumed by overseas companies. How and what could we be doing better to enable us to get our first $1 trillion valuation company? We get lots of unicorns, but we don't tend to get that multi-billion pound company that goes on to 500 billion pound company and more. They get taken over by our larger peers. Why is that?
I think we just need to be more ambitious. A, as founders, but B, as investors. We're very happy just taking a 30% premium when it comes along as a takeover bid. And I think we just got to think a little bit more long term and be supportive of these businesses. Companies like GBG were given a hard time by fund managers for not doing enough M&A. And then when they do an M&A deal, they're criticized for paying too much. And the shares get hammered. And I think in order to grow, companies do need to be acquisitive. And this can work. You look at Melrose, you look at Keywords. There's no reason why companies can't be serial acquirers and use that to augment their organic growth. But I think ultimately it comes down to us all being a little bit more ambitious and just having a bit more of a risk appetite for building these larger businesses. But I'm starting to see that now. I think last year we had as many tech and tech-enabled businesses in the FTSE All Share as we did back in 2000. So times are changing. Just need to keep up the act.
Brilliant, and I wish you and the team very well with that and London Stock Exchange. Now, another aspect of this sort of let's invest in and expose these companies that are of value to private investors. Now, how is the London Stock Exchange enabling and encouraging participation more of retail investors in IPOs?
Sure. So you'll be familiar with Primary Bid. This is a business that we invested in through their Series B. They are one of now several providers of liquidity to retail investors, which is great to see. And that was our objective, that we looked around the market, saw lots of banks struggling to involve retail in deals, sometimes not for any bad reason other than it was just complicated. That if you're trying to raise capital for Ricardo and you want to involve 1,000 retail investors in that issue, it's very tricky for a bank to expand that register, because suddenly you've got more retail investors than you have institutions, and sometimes not the regulatory approvals to even deal with some of these investors. So being able to leverage technology to make that journey easier for both sides, company and investors, it makes a lot of sense. And I think Primary Bid's been used on about 270 odd IPOs and ABBs, accelerated book builds now, which means that if you're a Ricardo, if you're a Cape, if you're doing a fundraise, you can put that deal up onto the Primary Bid app and that gets shown around. Peel Hunt's got a similar offering through their Rex platform. I'm hearing good feedback about that business as well. So it's just great to see, and I think the campaign in the Mail has also highlighted that retail shareholders are not all day traders or missold pensioners. There's people like you and I, saving for ISAs and SIPs, and this money is really as good as fund managers' money. We deserve an equal shout.
Brilliant. And to add to that, there is some stickiness with some of our investors as well, in the sense that we do buy and hold, and we're not looking to flip all the time as well. Now, we've seen some declines across 2022, Neil, across many techs and many stocks and tech stocks as well. And we've also seen a significant declines across the likes of Meta, Alphabet, Amazon, Alibaba, UK listings, including the likes of Wise, TP, Impact, and Oxford Nanopore. However, what I want you to say regarding that and your own investing portfolio, are you seeing these lower valuations as opportunities? And should investors be looking now to think, actually, a lot of people have walked away from these stocks, but if I'm thinking, like you said earlier, 3 years, 5 years, 10 years away from now to 2030 odd, these could be bargains for me to be investigating further, instead of going, no, not going anywhere near them.
I'm certainly of the view that there are bargains to be had in this environment, Peter. That if we wind back to previous downturns, there are moments that you go through as an investor and you think, is the world going to end? I remember being at Dresdner, where I was allowed to spread bets on the FTSE, and I think it was close to touching 3,000 at the time, and there were people around me thinking that, well, is this going to go any lower, or is this the bottom? It's really hard to time that bottom, but given where we were last year, we got carried away. I think we've got carried away in the other direction, that valuations have come off, and some of those companies you mentioned have been quite resilient. I was talking to Goldman Sachs earlier today, one of the banks on Wise, and they just reminded me that they start off at £8 billion of market cap, and it's probably close to 7 now. If you think how much fintechs come off as a sector, actually that's a stock that's held up pretty well in this environment. I'm sure it's been lower, but it's certainly come back, and it boils down to the fundamentals that if you're looking around Europe for companies with more than, let's say, $500 million of revenue, there's very few places you can look where you can sort of see companies growing as fast as an Adyen or a Wise. So there's an element of scarcity value, I think, in the UK that supports these companies for sure. But yeah, definitely some opportunities to be had. But it all comes down to doing that homework. It's very easy just to look at that pure share price and say it's coming off, but you've really got to understand why. And is the share price deviating from the underlying fundamentals of that business?
Brilliant. Now I'm trying to recall, and you can correct me if I'm wrong, were Wise, as TransferWise as it was, now Wise, one of the few companies that IPO without raising any money? Were they one of those?
That's right, yes. So it was the first US style direct listing in London, and the largest direct listing here. We've had other companies like Metro Bank in the past that have used this mechanism, but this was the largest. And the reason, Peter, was that this is a business that had been profitable for a long time, didn't feel that they needed to raise additional capital, would just thought that if they put the shares on the market and democratize access to all investors, that would be sufficient.
Yeah, that the market decides, and as you say, and you've used quite rightly, the art of what is possible regarding the market deciding. Yeah. Yes,
and now see, the sad reality is that a lot of companies that come to us do need capital, and that means that an IPO is perhaps the best way to do that. We've not seen as many direct listings and SPACs as estates, and I think that's really for good reason, that you've got a process here that works. We've seen IPOs like Phonics, like Calnex done in and LendInvest as well, done in 3.5 months from start to finish. It's a sort of proven process where you get that price discovery and a lot of support along the way. So I sort of wonder why more companies just don't default to this this default route.
I think they are slowly getting, the essence of why it's such benefit. And we said it's an international exchange, so there are more and more companies coming. And I think the beauty of it is that we nurture so many anyway. These hubs that we've got up and down the country. I spoke to Stephen Kelly, fantastic guy who's been, doing all things tech and doing Tech Nation, and former CEO of Micro Focus and Sage. We nurture so many companies, so we can list more of them and keep them listed. That would be phenomenal, I think, going forward.
Absolutely. It's great to see this flywheel slowly building. Stephen has been phenomenal and super helpful to so many founders and CEOs that I've met. He sent a few our way. We've referred a few to him that wanted advice on how to scale in the States, where he's very well placed to advise. And it's great to be able to call on people like Stephen, but also some of the VCs like Saul and Robin Klein, who have done so much for this ecosystem. And one of my biggest frustrations, Peter, as a banker, was that when I was working on the private side, I rarely met people doing public deals. And then on the nomad and broking side, had little encounters with VCs and private equity. And we're trying to fix that here at the exchange by bringing the entire ecosystem to bear. Because really, if we've got a strong stock market, that's in everyone's interest. It gives founders, VC, private equity optionality. And they know very well that if they're going to return to market with their next deal, you can't just sell a horse at the top of the market. It's got to deliver, and sort of separating what's a good company from what a good investment is vital. And I think those lessons are being learned sometimes the hard way, but it's great to see. And now I'm sure if we come back in 5 years, we're going to have an even more vibrant ecosystem. We've got a team of 20 at the London Stock Exchange scattered around the globe, and we're not only nurturing companies in the UK, but companies in India, where I'm next week. My colleague Tom Attenborough is out in Singapore, meeting some sizable companies, which may be too big for their home markets, too small for the US exchanges, but absolutely ripe for London. And ultimately, that means more choice for some of your viewers and listeners to invest in.
Brilliant. I love that. And I love also the fact that you actually purchased Refinitiv, which enhances all the big data and the AI technologies for all the companies to speeding and advancing the technologies going forward. So that's absolutely fantastic. Now, I'm conscious of the time. I've got 2 more questions for you, if I may, Neil. Neil, you're fortunate enough, and you said, you're going to go to India, etc., to see and witness thriving, innovative companies from across the UK, Europe, US, and the rest of the world. What aspects of tech at the moment is exciting you the most regarding investing, and why?
Sure. So I see opportunity across all of technology. Sorry to sit on the fence, Peter, but if you look at...
I don't want you to sit on the fence, by the way. I want you to just go.
But if you look at some of the companies we've seen, last year we had 7 fintechs listed in London. Most of those through IPOs, others through reverses. That's a trend that's continued this year with the likes of Funu. But if I look at our IPO pipeline, that's probably got the greatest concentration, and partly because London's been such a great hub for incubating these businesses where they've grown and scaled. VCs and growth equity firms have supported that journey, and now they're looking for the next stage, which has to be IPO. And there's a big prize there that financial services industry that hasn't been really disrupted for so many years, and now we're all realizing the benefits of being able to use our Revolut cards when we're traveling to Turkey, as I was last week, and how simple and easy that process is, or being able to purchase goods with Klarna or Zilch online, and the benefits. So I'm really excited about this crop of private companies, and that's just fintech. I could say the same for the video game space, where if you look at Sumo and Codemasters, these 2 companies, by the way, that I think grew 30% plus each year when they were on market, made investors money. So when Tiny Build and Devolver came along, there was a lot of interest for industrial companies in the space. The good news is that there are literally hundreds of companies in the UK, but also overseas of a similar nature. So there's no shortage of opportunity. Basically, you say what you want, and I'm pretty sure we could find it. Semiconductors is another theme. We've had two semiconductor businesses list this year, in Silica and Sondrel last week. And to think what a tough environment it is at the moment to get IPOs done, there was tremendous support for this strategically important part of the market where these chips are used in all sorts of devices. I think Sondrel's devices have been used in the iPhone, Oculus, PlayStation, Mercedes, Tesla, and this little company is based near Reading. It's phenomenal. We just need more companies like this, founder-owned, that have built a great business and can hopefully do so and grow that business on the market.
Brilliant. And yeah, I was just saying, on the London Stock Exchange, it's absolutely phenomenal. Now, I've got a final question for you, Neil, and this is a fun one. I think your children enjoy this question as well. You're a tech expert, so I'd like to close this interview with this question. Today, I'm granting you the power to change one thing for the betterment of all investors, small and large. What would that be, and why, Neil?
Oh gosh, there's so many things we could tackle. What one thing? So I'm a huge fan of EIS and VCT, and I think the limits, £20 million, is just too small in 2022. I think that needs to be significantly increased to help nurture some of these businesses and get them to a larger scale, and also give more investors who may otherwise not have the risk appetite to invest in some of these companies to support their journey onto the markets. Now, I don't think it has to be a huge step, but seeing a limit of £50 million would do tremendous good, and encourage more firms like Guinness have set up a VCT recently to follow suit.
Brilliant. See, that was a brilliant answer. Thank you very much for that. Neil, thank you ever so much for that interview. That was Neil Shah, Director, Head of Business Development for the tech sector of the London Stock Exchange Group. Thank you ever so much for being on the Investing Matters podcast with me, Neil. It's been an absolute pleasure speaking with you, sir.
Thank you so much, Peter.